Today, we are covering the capital market. In the capital market, Capital Market 2, that is the second discussion. If you recall, in our fiscal policy, while we were dealing with the external, borrowings, we said that we will cover the instruments of external borrowing while dealing with the capital market. So let's get into that now. The most important here would be foreign portfolio investors, NRI deposits. NRI deposits, masala bonds, masala. Of course, the regular guys are there. World Bank, IMF, the BRICS Bank, New Development Bank, and AIIB, Asian Infrastructure Investment Bank. I'll tell you something. You know, when China showed aggression on the border in the Galwan area, there was anti-China mood in the country. Government took some steps. But we borrowed some money from AIIB. A lot of these people who speak unnecessarily against the government, they said it's a China bank, you borrowed. That's nonsense. Why? In the AIIB, you know, India is the second largest shareholder. China is the largest, 30%. India is the second largest. I think we've got about some 7.5, whatever, second largest shareholder. 100 shares are there, AIIB. China holds the largest, 30%, that's a promoter. We are second largest. It's our bank. Why won't we borrow from AIIB? So that's one more. And then you've got the Asian Development Bank, just like World Bank. You've got the Asian Development Bank, Asian Infrastructure Investment Bank, that is China, whatever. This is the regular World Bank's regional sister body, Asian Development Bank. See, by habit I wrote IMP, important. I meant to say IMF, International Monetary Fund, but I wrote IMP. This is what habit can do. This is what Gaza can do. My mind is on, saturation watching, binge, kind of, but then we can't help it. Today, this table did not have. There's a lovely article about Israeli stranglehold on Gazan economy. How Israel controls Gazan economy. And one of our friends on day 1 or day 2, he asked about why the Israeli currency shekel is dropping in its value. About that I have seen an article somewhere, maybe the Hindu yesterday. Why it is dropping? Nobody is confident about it. So why won't it drop? People sell off. That is when you drop. So World Bank. See, Article 292, 293. What are these? 292 is about the borrowing powers of the union government. 93 state. 93 says, 293, states can't borrow from outside. So from the World Bank, IMF, ADB, you know, these are separate banks. I'm talking about World Bank, IMF and ADB. And NDB, AIIB, what is the structure? We'll see. Government of India will borrow and pass it on to the state. States cannot directly borrow. That is 293, categorical. States cannot borrow from outside the country directly. They can get the funds from the union government that can borrow from outside the country. So 292 is the Government of India and its power to borrow, how it can be regulated. 293 is about the state governments and their borrowing powers, and that explicitly says that you can't borrow from outside. So only the union government. Today in the Hindu you will see somewhere ADB, Asian Development Bank, Manila, 67 members, maybe one or two have added. $400 million has been borrowed. Borrowed, and what do you do with it? Pass it on. To whom? Some state you pass it on. And they will return to you, you will return. If they don't return also, you have to return. For what do you borrow? You know, World Bank has about 190 members or so. Why do you borrow? You can borrow for development. Their objective is to ensure there is no poverty in the world. Multilateral Development Bank, Larry Summers and N.K. Singh Committee. That Larry Summers, N.K. Singh Committee is very likely in the preliminary and the main also. Larry Summers was the Treasury Secretary of Bill Clinton for a short while, and N.K. Singh is the finest civil servant come leader and all that. Both of them headed a committee set up by the G20 to suggest reforms in the multilateral development banks. This and this. These are China, whatever, BRICS. You know. Multilateral development banks. What kind of reforms? Very simple, very, very simple. Lend more money, number one. That is all. Please understand, what does the common sense tell you? These guys have a lot of problems, the South, global South. Lend them more money, number one. Secondly, lend them fast. I've applied for a loan and you will give me after a millennium, right? And more people have gone below the poverty line, become malnourished. Lend more, lend fast. Third one is, lend for projects linked to the sustainability development goals, sustainable development goals, those 17. Lend for that, climate, renewable, this and that. They have suggested this, and also let them speak louder. That is, in these banks, whatever voice they have, increase the voice, give them more voting power. So that is Larry Summers, N.K. Singh. I'm 75% sure it will come in the next year, both May and September. So World Bank gives you money for you to take up any development related project, road, dam, power plant, school, hospital, afforestation, you name it. and they'll lend you. That is WB. IMF is a little different. You know, IMF is, remember we went to the IMF in 91, when the country, a member country obviously, does not have, when the member country does not have enough foreign exchange reserves for them to import, for them to repay the loan, two important things. Then a member country is entitled to be lent money by the IMF, and the unit in which you are lent is SDR, Special Drawing Rights. Because they are a global body, they can't use a national currency, and therefore they have created their own quote-unquote currency, reserve unit, account unit, artificial currency, SDR, they'll lend you, and then you will take the SDR to any country, central banks. Sir, I've got $1 billion SDR. Today it's going for $1.5 in SDR. Give me dollars because my job is in dollars. But you can't trade in the market like you give $1 and take rupee. You can't go to the market. Only central banks can trade in the SDRs. So what's an SDR? It's IMF, this and that, convertible into hard currencies. With that, you can conduct your global financial transactions and all that. IMF. NDB, AIIB. NDB is a BRICS bank. We don't know what to call BRICS now because there are so many BRICS. When you had only BRICS, it was BRICS. Now you have Saudi Arabia, Iran, whatnot. So 6 plus 5, you got 11 countries. So BRICS plus 6. That's a BRICS bank. Same thing it does. Our bank, equal shareholders. How the shareholding will be distributed among the 11, we don't know. That will happen on the 1st of Jan. Before then, you will have some rules. I'm sure it will come in the preliminary and the main. You know, sure means 75%. AIIB. This is, I told you, China initiated, and more than 100 members are there. We are the second largest shareholder. Asia, infrastructure, investment. They'll give you money to invest in infrastructure, ports, airports. ADB is, I told you, the regional counterpart of the World Bank, Manila headquartered, Philippines. They do the same thing as the World Bank does. World Bank is a part of UN, ADB is not. IMF is a part of UN. These are the UN specialized agencies. Now you come to where the action is. This is where the action is. Why? Something more difficult to understand. Difficult means, you know, more dynamic. See, NRIs come into picture in two ways. One is NRIs are there abroad. You know, remember one thing about the NRI. NRI is a citizen of India who's not lived in India for half the year. Therefore, he is called non-resident. If he's been outside, I mean, you have to live here for 182 days continuously, whatever, broken up also. 182 days you live in India, you are a citizen, you are a resident. But 182 days you have not been here, so you are a non-resident. But citizen of India, you can vote and all that. Come vote, there is no problem. But you have to come here and vote, not all the proxy, postal. Come here. So NRI, your taxing rules are different, that's another thing. In two ways you come into Indian economy for our consideration. One is, your kids are here, family is here, and you are NRI for them. Keep 100 rupees from where they can draw their money and then they can sustain themselves. Or both the husband and wife are outside, kids are here studying in Delhi, keep a little cash, they'll draw the money, school fee, whatever. So keep 100 rupees. So rupee account the NRI can keep. NRI also can keep the dollar account. You know, today American rates are very high, 4, 5 and all that. Today, which is absolutely unusual. I've never seen anything like this for the last, say, 40 years. Generally, American bank rates are 1%, 0.5%, 1.5% is very high. So NRIs, their dollars we require, therefore RBI told India's commercial banks, you give whatever rate of interest you like to NRIs for them to deposit their dollars in your account, and we can use the dollars because we are short of dollars. So NRIs can keep rupee deposit, dollar deposit. Dollar means foreign currency. Rupee deposit, dollar deposit. So the dollar deposit of the NRI, when you use it, it's a dollar loan. Rupee deposit of the NRI that you use, it is a foreign loan because the source is foreign, but it is a rupee loan. So you are India, NRIs are there, they are outside India, they have got the rupee deposits, and I am using that rupee. After all, why have you opened up this rupee account for the NRI? You want that rupee, you are giving him interest, that's your rupee, means you have to return. He put the rupee, he is outside, foreign, kind of, lend the rupee, 8%, give him 6%, from the 2 you take your profit. So, you know, there is a certain misunderstanding about foreign loans being always foreign currency denominated. I have busted it to begin with NRI rupee deposit. And I was telling you NRIs are associated with the Indian economy in a more important way. Dollars, they come in 2 shapes. One is the NRI keeps his dollars in the Indian bank because Indian banks offer astronomical rates of interest at one point, very high rates of interest. I don't know what's happening today. They still keep because we give a lot of interest. Another channel through which the NRIs send the dollars home would be remittances. $100 billion, you know, $100 billion is the remittance we are getting. All of them are not NRIs. Remember, your grandfather went to America. Grandfather. And, you know, he could also be, he's not an NRI. He's a PIO, person of Indian origin. He is sending you $1 lakh remittance. Remittance is all the people of India, outside India, they are working, settled, whatever. Not necessarily NRIs, they could be person of Indian or PIOs also. They have been earning and they are sending money to India, foreign currency. So remittances are foreign currency. NRI dollar deposits are foreign, but NRI rupee deposit is a rupee loan taken, loan, it's a loan. You have to return at interest, that's loan. So what India gets from the NRIs by way of rupee deposit is also a part of the foreign loan, subtitled foreign rupee debt, You know, we are paying in rupees for Russian oil and all that. That's not debt, They give you oil, you pay them in rupee. Little bit of rupee you pay, little bit of dollar may not be, yuan, you pay. I'll come to that later. So NRI rupee deposits a foreign loan. We are talking of external debt in the capital market. Let me explain the masala bond to you. Masala bond. Interesting. You know, so we have Indian companies. In India, this much is the liquidity. Interest rate is X. This is the liquidity. This is the liquidity. Interest rate is X. There's a lot of pressure on the liquidity. Rates are high. That's an assumption. So, what do Indian companies want? They want to borrow in rupee from outside, paying little less rate of interest. How is it possible? Let me explain. This is the world, and this is a financial institution. And in this world, this is India. Yeah, India is a part of the world. So there's a financial institution like Morgan Stanley, just another name, XYZ, JP Morgan. Or the World Bank Group, there is a body called the IFC, International Finance Corporation. So okay, XYZ, finance company, globally renowned, AAA rated. So you are the guys having euro, yen, dollar. You're also looking for chances for a good return. Today there is not too much of market because everyone is giving you good return. Those days when outside India you were getting in America 1%, 0.5%, you were attracted by lending to India. Now they are giving you pretty good returns. So you guys have the euro, you guys have the dollar. I am the global finance company, pretty highly rated, and I deal in foreign currency. So, what do? I tell you, friends, you give me your dollars, take this bond, I'll convert the dollars into rupees, lend to Indians. How much? 100 rupees. What is it that I give you? I'll give you whatever rate of interest. Will you return the dollars? Yeah, of course. Give me dollar, take back dollar. Will you pay us interest in dollars? Yeah, of course. B and U we deal only in dollars. But I have to tell you, I'm converting this into rupees and lending to Indian companies. I will lend them 100 rupees. They will return to me only 100 rupees. Rupees 75, 85, 65, 95. Exchange rate risk is entirely mine. So I'll convert them into rupees at a certain, 100 rupees. Some interest rate, 7.5. And they will give me rupee. I'll reconvert it into dollar and give it back to you. I'll give you dollar. And my dealing with them is rupees. This is called a masala bond. I float a masala bond to you. I'm calling it masala bond because masala is an Indian term. You see, you have to always attract. While selling a bond, you should give it a, sort of appealing name. Masala. Tomorrow, biryani. There'll be stampede, biryani bond. Oh, they'll chew the bond. So, the masala bond is identification with India. So, Indians are happy. They're getting rupee. They're paying back rupee. Interest is rupee. They have nothing to do with exchange rate. They will lose if the rupee appreciates. When will the rupee appreciate? They will gain if the rupee depreciates. That is the norm. And rupee stays there. How are they losing or gaining? How are they losing? They are not losing. My deal is, I deal in foreign currency. I get into derivatives and stuff and buy and sell, and I'll make sure that I won't lose, I'll gain. At any rate, in my whole operation, this is a peanut. So why am I doing it? I'll make money. Even if the rupee depreciates, I know I'll make money because I keep dealing in it. Why am I taking the risk? It was done at a point when there was no risk at all. Rupee was staying flat at some rate, hardly any risk. And a little bit of interest rate differential, I'm paying you interest of X, I'm charging interest of Y. That gap will more than make up for any drop in the value of the rupee. So I'm a net gainer. And I'm also helping India. Because when I'm converting a dollar into rupee, the dollar is in India. There's demand for rupee. Rupee won't drop in its value. RBI can pick up the dollar. Rupee will stabilize. Dollar will be there in India. RBI can pick up. Indian companies are getting money, rupees, at a decent rate of interest. And there will be less pressure on the liquidity in India. I'll make money, you'll make money, everyone is fine here. So that's the deal about the masala bond. I can wait here for a few seconds. But then I've told you everything. This is masala bond. So why did I tell you masala bond now? I told you about the masala bond now because we are talking about external rupee loans. It's a rupee loan. The source of the loan fund is outside, so it is external. So if you by any chance think that all the loans you take from outside India are necessarily in the form of dollar, foreign currency, that's not 100% correct, because a lot of the loan that we take from outside is rupee loan. Masala is rupee, though you don't hear of masala now because the rates abroad are pretty high and that's very attractive, and therefore nobody is ready to do all this masala and all that. NRI deposits. Now you come to FPI. FPI consists of foreign portfolio. Foreign portfolio, investors. One is foreign institutional investors. Another is sub-accounts. And the third one is qualified foreign investors. Qualified foreign investors, QFIs. So I want to explain this first, and then I would like to also explain participatory notes. About that, there's a 50% chance it could come in the exam because the picture is good. See, all these are rupees. They are all rupees. So foreign guys are there. Indian stock market is going down because Gaza. Not because guys are getting butchered in Gaza. No one has a heart here. The markets are slumping because the conflict could widen. Why are they halting? No ground offensive. Some people are saying they are already killing so many people from the air. Why enter on ground? That is okay. But even Israel is thinking second time, third time, because, it's not an ordinary crisis I have ever watched. So, Indian stock markets are slipping a bit, slumping a bit. It will come back because elections are around and so on and so forth. It will come back. So foreign portfolio investors, portfolio means what? The variety. These are the shares, this is the commercial paper, this is certificate of deposit, these are the bonds, and these are mutual funds, and this is your portfolio. Portfolio is a variety of any variety. Government of India, the Council of Ministers, portfolio. These are the portfolios. So similarly, what's your portfolio? If you ask a FPI, he will say all this. So there is a foreign institutional investor. He told the people of that country, Japan or whatever, see, I'm going to India. India is shining. They are doing everything right, you know, and its economy is picking up. They are into artificial intelligence and semiconductors and whatnot. So future is India. Let's go invest in India. You guys, give me $1 each, 100 rupees. I've registered with SEBI. Sir, I'm coming with $100. Whatever, I'm coming. This is me, my details. This is the disclosure. All details you want. I want to register so that I can participate in the stock market. Stock means all, whatever trades in the stock exchange is a stock. All these are stocks. They're all trading. Of which shares, of course, are the lion's share. Get registered with SEBI. So I get $100, convert them into rupees, and I do my business in rupees. Share we are not talking of now because we are talking about loans only. Shares we are not talking. So the $100 that the foreign institutional investor gets who is registered with SEBI, some of it will get invested in bonds, government bonds, corporate bonds. And that investment we are talking about because our focus is on loans, debt. That is one part of it. Rupee, he is investing. Reliance bond, 100 rupees. He is buying with rupee. All that he does in India, he does in rupee. He gets dollars, converts them and does the work in rupees, and when he feels like going back, he converts them back to dollar and goes. So all that he does, buying and selling, he does in rupee. So the foreign institutional investor who is the primary part of the FPI, he brings dollars and converts and does his work in rupees. Now, there are 3 foreign guys, I can give you example. This guy is there, he is working in some laboratory and his job is science. He doesn't know finance, so he gives $1 to the FII. Okay, go to India, go to Malaysia, South Korea, wherever you go, you generate me returns. Here is the $1, take it. So he gives money to the FII, registered in SEBI, mutual fund type. There is another foreigner. He says, why should I go through you? I can invest on my own. I know India, I know Malaysia. Everything is by a click of the button. So he is the QFI. There is a university. That university has a lot of money. They have to invest somewhere. They can invest on their own. Earlier they would come via FII. For the last 10 years, they can invest directly on their own. No SEBI registration. Come directly, get the dollars, convert them into rupees, open an account in the Indian bank and the demat and all that. You can invest and do whatever you like directly. Qualified foreign investor, QFI. Qualified because not everyone is eligible. There are about 40 countries who are members of the Financial Action Task Force. All those 40 countries are acting very tough on money laundering, so money is not terror and all that. So those guys, when they bring their money, I'm confident the money is clean and not terror money, so they can directly invest. They don't have to come through the FII. They are called the QFI. All the insurance companies and universities and charities and individuals. The third guy is a fairly high net worth guy. He tells the FII, see, you're collecting money from everyone, dollars going to India, Malaysia, wherever, we're talking of India, and then you're doing all your work there, you know, and then you're giving them 5%, 6%. I don't want like that. I'll give you separately money, $10 I'll give. Open an account for me, which is called sub-account. Manage my, cash asset. Here is the $10. Show me what have you bought. Where is it? How much have I gained or lost? What is the net asset value of my wealth? You are my wealth manager, etc. They are called sub-accounts. So in the FPI, you've got sub-account of the high net worth guys, individuals, and then you've got the QFI. So this is FPI, FII, sub-account, QFI. Together they are called FPI. All of them have one thing in common, that they bring foreign money into India, do their work in rupee. So all that you are getting from outside to the FPIs, that is the rupee debt. Rupee debt. Not if it is invested somewhere else. If it is invested in the debt instruments, bonds, government or private sector, government or private sector, it is a debt, foreign rupee debt. Now I'm coming to the promised participatory note. Participatory note. So once again, FII. You know, there are so many people outside India, they don't think too much of India because they want to make a lot of money. In India, you can't make a lot of, sort of. And they are focused on Taiwan and South Korea, Japan, America, Germany, France, London. You know, India still for them, Hong Kong, India, Singapore, they are not too kicked about India as of now. But they know stock market has to go up. Unless there is a nuclear war and all. Because there are two madmen in town, Netanyahu, Putin. Either of them could trigger because these people are. And then these Hamas fellows. We don't know what sort of dangerous instruments are at their disposal. You know, you can't be stubborn about it. After all, people are dying. You can't take revenge. You killed 1,000 of my people. I have killed 7,000. Let's quit. I've taught you a lesson. So it could go anywhere. You know, except if a nuclear war takes place, otherwise, Indian stock markets have to go up. They're settling down a little lower so that they could flare up again. May elections, April, May, you have to go up. So guys are waiting for this. So there are people, they don't want to get registered with SEBI. They don't want to disclose all the details. $100 he has. So he'll come to an FII. You know, you are registered with SEBI. You are invested. So you do one thing, take my $100 and sell me a note of participation, participatory note. I am participating in the stock market via you. You are registered with SEBI. Take this $100 and give me a $100 note, participatory note, a derivative, whatever, offshore. I'm outside India, so offshore, derivative. So derivative means what? You are invested there. You bought Reliance, you bought TCS, you bought Coal India. They are going wherever they are going. And I would like to participate in your investments by buying a note from you. And if your assets go up, my value also goes up, etc., etc. So it's basically an FII sells a participatory note to one outside India, and that participatory note can be, I've got a participatory note, you are the FII, I gave you $100 and I will sell this participatory note. So basically it is a note of participation in the stock market sold by FII to one outside India. So what is my benefit? My benefit is Unlike other guys who gave you $1, $2, etc. Why can't I open a sub-account? You know, about sub-account, all these things, I don't think we need to go into so much of detail. Sub-account I can open, but I'm an institution in my own right, number one. Somebody gives you $10, tells you to invest in Reliance and TCS, that's a sub-account. Or you invest wherever, show him transparently, wealth manager. Whereas when I buy a participatory note, that note is there, I can sell it in Singapore. See, this is a participatory note for the investment in the stock market. And I put 100, it has become 105. You want to buy? Okay, I'll buy at 105. He will sell to somebody. So a participatory note is tradable, unlike a sub-account. You know, you could build on the differences and similarities later. There is no need. So a participatory note is, number one, a foreign investor buys it from a FII registered with SEBI, and the details disclosed about the foreign investor who bought the participatory note are limited, and that offshore derivative instrument is tradable globally. Globally means Singapore, London, etc. Wherever allowed. That's about the participatory note. If you have a question, I should be able to answer that on the participatory note. I'll wait. Please take your time.
So interest earned on NRI deposit masala bond are taxable or not?
You know, you must speak.
The interest earned on NRI deposit and masala bond are taxable in India or not?
Oh, I got rupees. I have to return the rupees. I have to pay the interest with rupee. That's all about the masala bond. What I do with the money, the regular tax laws apply. Isn't it? So, where does taxation come here? It's another thing you are raising in dollar from the global market, selling the masala bond. But my deal with you is this. You gave me 100, 3-year, 7%. Here is 100, every year, 7%. That's it. How do tax laws come here? No? At a plain level, whatever laws are there, they apply. You mean to say any tax concession? Yeah? Why? Why? You mean to say extra tax? Why? Who are you incentivizing? Who are you disincentivizing here? It's another rupee loan. Your liability is in rupee. No? Clear? That's it. Don't get hijacked. You know, it's commonsensical. You are eminently qualified to, you know, see what it is. Unnecessarily, take your time.
Sir, are participatory notes domestically traded as well?
You know, offshore derivative instrument. Offshore derivative instrument, they would like dollars. Domestic is rupees. If they trade in Singapore and Hong Kong, they trade in dollars. Here they get rupee. Why will they be interested in rupee trade? No? Take your time. Pull your mind together. Focus on it. Dig into it. See the implications. All with the common sense lens. See if I can come into the picture. You know, season is changing, so I hope you don't mind me And on top of that, Gaza. You know, earlier we used to see videos of one person being killed and get shocked. 1,000 being killed. If we can come to terms with that, 1,000 in one shot. There's a journalist speaking. His wife is there, son is there, a daughter is there. If you follow him every day, while he is on his job, they get killed. Not seen anything like this.
Sir,
Yeah.
how are these foreign institutional investors are regulated?
How are they regulated? SEBI regulates. You get registered with SEBI. Registration means what? Follow the rules and regulations. No? Where are you from? Whose money is it? When were you set up? Who is your board? What kind of investments you would like to make? All, whatever disclosure you have to make, you make. Isn't it?
So, but in case of P-note, there is no disclosure, right?
P-notes are, you are the FII, you are registered with SEBI, you are selling the P-note to someone outside whose face the SEBI has never seen. So the control over P-note is via you. You will tell me, sir, these guys won't give you information beyond this, but they are ready to invest billions of dollars into your economy. So, sir, you look the other way while I'll give you a little bit of information. It's okay, bring dollars, bring dollars. So these are outside, they buy the P-note, they trade the P-note outside India, and I have you with me, you follow all the rules. Via you, I'll impose some rules on them. Indirect. You know, ultimately, color of the money doesn't matter, does it? I want dollars. These guys don't want to get registered. No? I'll give you a picture. If you are interested, I'll take you back to 2007-8, when these guys were flooding into India. Participatory note money is coming so much into India, I will give you a situation that you won't be able to believe. So some FIIs are registered with SEBI. They are selling P-notes to all these guys, and it's not a million or 100 million, it's billions. You won't believe this, follow me. So when these guys are coming into India, all those billions of dollars coming into India, chasing rupee, something you never heard of happened. Rupee was 47, 46, 45, 44, 43, 42, 41. So rupee was appreciating beyond your imagination, and if in your pride of India, if you think the stronger the currency, the better for the country, no. Just imagine, if I can buy a dollar with 40 rupees, earlier I used to at 48, now 40. What will I buy in India, you tell me? Even my apples and oranges, I will buy from outside because dollar is so cheap. What will you make in India? What taxes? What employment? Nothing. So the cheaper the dollar, in terms of rupee, the greater the danger that you won't make anything in India. No? So the government said, friends, register with SEBI. The idea is to keep them out. We don't want so much of money. We can't handle so much of money. So how do you tell them not to invest in India? Cut down on the participatory note, tell them to get registered with SEBI, fully knowing they'll never get registered with SEBI because we don't know what kind of money that is. So, telling them not to come into India because rupee is getting stronger with dangerous consequences for Indian economy, you didn't say that straight. You said India is not running away. We are a demographic dividend-driven economy. we are here forever and ever, get registered with SEBI and then come. They won't get registered, they won't come, pressure on rupee, pressure, positive pressure is off. Now, your question is, have you got your answer? Okay. Ask me anything related, because I've spoken for 1 hour or so. Fairly concentrated stuff. You need to put it, logically connected. I'll wait for a minute. So now you know remember one channel through which he can confuse you. He will confuse you by mixing up loans and shares. Loan is I take the money, I pay interest and return the loan. Shares is I sell you the share and you share the ownership of the company. If the company does very well, you are, partying every day. Company doesn't do well, then we all go down. You and I are the shareholders of the company. God willing, do wonderfully well, keep partying. Something goes wrong, the ship sinks, we are all finished. So I owe you nothing. I sold you a share for 10. At one point it was selling at 15. You didn't sell. Today it is 0 because the company is nowhere. It's okay. 15, 0. I owe you nothing. I sold you a share. I'm gone, you're gone. Here I took a loan of 10 rupees from you, 7%. So loan is loan. Shares are shares. Shares are not repayable. Loan is repayable with interest, whatever the interest. He tried to confuse you on that. I hope you're clear. I'll again wait for you here. Loan and share.
Sir, difference between debenture and share.
Debenture is a type of a loan, deposit. Loan is bond. Debenture is you give me the money, I'll give you interest, and for 1 year, 2 year, 3 year, I'll return. Give me 100, 7%. It's like a deposit or a bond or a combination of the two. I'll return the 100 at 7%. It can be convertible. The other one, share. Share is the ownership. I'm XYZ company. Take this share of mine, 10 rupees. Share means share in the ownership of the company. I don't owe you 10. You gave me 10, I put it in the economy, the company. And wherever I go, you come along, we all go together. If the 10 becomes 50, super joyed. Bad luck. So I owe you nothing. In a share, the company that sold the share is giving ownership of the company to the one who bought the share. You've got 100 shares in your company. The company totally has 110 shares. I have 1 share. You and I are equal. We are co-owners of the company. The difference is you have much more. That's okay. But technically, we are all shareholders. We all together share the ownership of the company. Got it?
Yes, sir.
Yeah. Take your time. Take your time. Yeah.
So portfolio investment is, can we say that the collective ownership if it's 100% share?
Portfolio is what? The variety of investments. That's all. Variety of investments, that is the portfolio. Foreign portfolio investors, FPI, these are the 3, subsets of the FPI. I told you all the 3, FII, QFI and the sub-account of this. They are the FPI. And portfolio, wherever you go, you know, the variety, that is a portfolio. You know, you play sports. What's your portfolio? You know, you play cricket, tennis, football, kabaddi, all that. That is your portfolio. No?
Yes, sir, in terms of ownership, for example, if it is a mutual fund, it's also a portfolio. So how the ownership works in that?
Mutual fund, take money from people, invest it. Yeah, I'm your commission agent. I invest it. And wherever it goes, it goes. I'm not promising anything. You gave me 1 rupee, you bought mutual fund units, 1 rupee. I picked up 100 from 100 people, 1 rupee each. Just like a share. Did I promise you anything? Nothing. It can, the 1 rupee can become 5, 0. So what did I promise you? Nothing. Your money I am handling, that's all. You are the owner. But what do you own? Whatever your money becomes, that is what you own. You may be owning 5 rupees for the 1 rupee you contributed initially, or you may be owning nothing. That depends upon what happens to the investments. No? Got it? Yeah. Take your time. This is, you know, it requires some practice. So I'm here to help you juggle, you know, the concepts.